As 2021 draws to an end, we seem to be faced with central banks divided on how to steer the path of monetary policy to fight off the resurgence of inflation. We still have a lot of uncertainty ahead, but the general consensus seems to be that inflation is perhaps not as transitory as central bankers were maybe hoping for. Joining me today to discuss his views on what to expect from central banks in 2022 is Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Marc, welcome.
Oh,
It's great to have you. Before we get into each central bank and what we're expecting in 2022, I just want to get your views quickly on where central banks find themselves at present. Now, it's been a very hard year and a half, and it's been really hard to predict what's going to happen in the economy. The fact what we've seen with COVID is not a normal recession. It wasn't the fact that people didn't have the capacity to go out and spend or didn't have the purchasing power to do so. It was more so the fact they weren't physically able to go out and spend. So I think I want to get your views on what have they done? Have they potentially overreacted in the beginning of the pandemic? And I know it's very easy in retrospect to give your views now that we're 18 months down the line. But do you think potentially, and given the situation they are in currently, maybe were they overreacting in the way that they were pumping the economy and cutting rates without really trying to understand what the longer term impacts for the economy would be?
I think it was very much shooting from the hip in the first place, and it was with a total lack of visibility in the sense that no one really knew what was going to happen with the pandemic. The initial assumptions were, well, this will be just something short, something along the lines of what we saw with SARS or MERS. And that it wouldn't have a long-term impact, as it turned out, particularly because of the measures that were taken to lock economies down. There was a colossal shock to the economy. We have bounced back very, very sharply. Now, the bigger problem is actually that this comes after a very long decade post the global financial crisis of pumping in endless amounts of liquidity. And only the Fed really ever had a go at withdrawing that. So all the extra liquidity, which basically amounts to all, in the past year and a half, to the same as they pumped in the previous 10 years, is now sitting around. And their biggest challenge actually is to withdraw it, A, without upsetting the economy, B, without really knowing how we're going to what the longer term things, the consequences of learning to live with COVID is. And then they've got this other big problem that basically what the pandemic has exposed is a whole lot of fragilities in the global economy. We had been sort of talking about deglobalization, but we've basically torn up the normal just-in-time production methodologies. Globalization, well, it's been a case of where can I find this? I need this now. And that's what the fundamental supply chain problem is. And it's not something which is going to be resolved very quickly. Everyone thought it would be. And that's really where the crunch point comes, simply because if we don't know when those supply chain problems are going to resolve themselves, we can't really make a guess on when we get to a more normal operation of economies. And the movement of people, I think there's two aspects to it. We've got the general velocity of people moving around in the services economy. So people going to offices, buying their sandwiches and that part of it. But there's another one, which is actually just as important, which is very important in terms of the supply chains. And that is actually the movement of people between states, so that when you actually start to have a very sharp recovery like we've never had a recovery like this for 80 years, you have that freedom of movement, and we haven't got it at the moment, and it's absolutely critical. Now that all plays out into how we handle the wages thing. Now I think the interesting thing that we've got to now in terms of what we've had this week from the central banks, particularly that contrast between the ECB and the Bank of England and the Fed. The Bank of England and the Fed are clearly worried about inflation getting a lot of traction, and to a certain extent, their inflation rates are a little higher than everybody else's. But then again, housing plays, isn't included in the ECB's measure, HICP, so it does look higher. The ECB, on the other hand, is saying, well, to be honest, everything, we're not seeing pressure on wages, really. We think about 2/3 of the increase in inflation is all to do with energy, and, well, there's not much we can do about it. That's correct. But it will at some stage, does run the risk of spilling over. So they are now trying to handle this situation of trying to withdraw some of the liquidity because they can see that asset prices are so overblown. At the same time as they try to rein in cost inflation, basic cost inflation, and they're in a very vexed situation that a lot of that cost inflation is something that they can't do anything about with interest rates. A lot of it really would have to be addressed via fiscal measures, be that subsidies, or more importantly, and there's no magic wand here, doing something about the very poor state of infrastructure that we have, above all in the developed world.
Yeah, so you were talking here about inflation, how it's, at all-time highs, and it's not just one source of inflation, as you were saying. There's so many different sources that are difficult to handle. And that's led basically to a situation where real rates that are all-time lows and negative, because we have inflation shooting up, and unfortunately those interest rates aren't able to follow suit at the moment. Now, what do you think, and this is obviously in a general view, what would be the optimal conditions for banks to start raising rates without having to be worried about stagflation and about growth, and what impact that will have in the economy in the short to longer term?
I think this is really what the biggest challenge is. There is no ideal situation anymore, because we know that COVID has changed a lot of consumer mentalities, not only actually in terms of their consumption habits, but also their attitudes to work. We have the added complication that we were always going to face, but it's become acute because it's quite clear that quite a lot of the baby boomers who are going to be leaving the workforce are leaving it in a much greater hurry. So we're suddenly in the situation that we're actually facing a skills shortage, which we can't address very quickly. And that is definitely going to create some wage pressures. We, on the other hand, have the technology to do a lot more digitalization than we've done. Now, how you mix that into the central bank policy mix, because really the key here, the people who are going to get this right are going to be the central banks who have governments who are willing to work with them and take some of the weight off their shoulders. The Eurozone is in a particularly vexed situation because it requires reforms in the Eurozone for that to, a lot of basic reforms, which there just doesn't seem to be, there hasn't been willingness to do for a very, very long time, but it's very much needed. In the US, you actually look at what Mr. Biden's trying to do, and really the social spending bill isn't necessarily the right way of addressing it. It may have voter appeal, and we've got midterm elections coming up. These are probably not going to be working that closely with the central bank. What it is really needed is solid infrastructure spending, and that needs to really be quite accelerated. And then he needs also to sort out his energy problem, because this is the other big challenge for central banks. If we put so much ESG pressure on the major hydrocarbon investors, we are going to end up in a situation having had very, very low levels of investment in particularly the oil and natural gas sectors since 2014, since the 2014 oil price crash. And if we pile the pressure on investors and on those companies, basically not to invest in hydrocarbons, we actually could be in a situation where we have such a shortage of supply of hydrocarbons, which are going to be needed for such a long time, that you could have oil prices going up into the sky, just like you have natural gas prices. What can a central bank do about that? Well, the answer is pretty much nothing, but they are going to be asked to deal with consequences, simply because this is a non-discretionary area. If households' electricity and gas and petrol bills are all going up, then they are going to demand higher wages. And that's a situation where central banks are going to be severely challenged to use the interest rate or broader monetary policy tools to resolve the situation.
Yeah, so let's have a look now closer at each central bank, and we'll start with the Fed. In the December meeting, we saw them accelerate their rate of tapering. That was largely expected. We also saw the dot plot updated, and the median projection shows now potentially 3 rate hikes in 2022, at least one, where if we were going back 3 months, there was still a lot of uncertainty in terms of the members, if that was actually going to happen in 2022. These projections suggest a more aggressive rate hike path in the short term. What do you think is going to happen? Are we going to see these rate hikes actually happen? Are these FOMC members really concerned about inflation? Is this the picture they're giving us? So they're trying not to worry us too much, but the way these projections have changed, does this mean that they are concerned about it and we are potentially in for 1, 2, or even 3 rate hikes in 2022?
Well, there's the key thing in all this, as it has been actually for the past 10 years, because we talk about inflation, the Fed's obviously has an employment mandate as well. They don't know what full employment looks like, so that's going to be a big challenge. But for the time being, they're very much focused on the inflation part of it. But they're always focused on financial conditions. And this is really going to be the key. What happens when they do start hiking rates? The market's basically saying they'll probably go in June and then do 1 per quarter until the end of the year. But the market also has a lower trajectory in the longer term, because it is, once we start a rate hike cycle, it's always then a matter of where are they going to stop? And what markets are basically saying is, we think you're going to be forced to stop earlier because you'll create a situation where financial conditions tighten, and financial conditions tightening basically means credit spreads widening, volatility in markets getting that much larger, credit availability not being so great, and then asset prices starting to fall very sharply. And it is the financing conditions, one would also have to say, in financial markets rather than for the man on the street. And suddenly asset prices start going backwards, credit spreads widen very, very sharply, and you get into a seizure, and they're forced to turn tail. We've been through this a couple of times in the past 10 years. And that's what markets are basically telling the central banks. The key is really going to be managing the narrative. Thus far, the Fed is managing it fairly well. It's been wrong, but it hasn't lost the trust of markets. The really bad situation would be if markets basically felt they've lost control of the narrative. And that's really where the critical point's going to be, and how all this huge amount of leverage, because of the QE that the Fed's injected, is going to impact all of that.
Yeah, so it's definitely a very delicate balancing act in terms of when you start to attack inflation and to really be serious about bringing it in without potentially hindering growth in the longer term. And that's really where we are at the moment, a lot of uncertainty with that. Let's focus now quickly on the Bank of England. They took it a step further in their December meeting, and they actually hiked rates. Some will say a surprise, some will say not. I definitely say since the Omicron fears in the market, those rate hike expectations had come down quite a bit. It was pretty much a 50-50 split going into the meeting, whether they were going to hike or not. They eventually did. What does this tell you about their concerns about inflation, and what are we expecting from them in 2022?
Well, I think the bank's biggest mistake is to abandon forward guidance. They basically, Mr. Bailey said, well, we don't want to tie ourselves into a corner. Well, neither the Fed or the ECB has actually painted themselves into a corner. They've built in an amount of flexibility, and they provided some guidance saying, but we could be proved wrong, and we may have to take other actions in either direction. This is where the bank's problem is. The problem is they signaled a rate hike in November, didn't do it. They basically said, well, actually, we're a little bit worried about all the other things that are going on in the economy. We probably won't go in December, and then they do. So they've got a communications problem. And The market's pricing in 1% rate by the end of next year. I don't actually think that's what the market thinks in terms of the economy of what's going to happen. I think that's basically just the market putting in a bigger premium, risk premium, because it doesn't know. My guess is that with the way things are developing, they probably won't go again in February. They might well wait until May. But what I think the rate hike this month told us is there is a certain level of inflation where they just feel that they can't keep the inaction bias, as the IMF called it this week, and they have to take some action. Now, there is a big risk there that they could easily fall into the trap of taking too much action. Because I think the UK economy has a good deal more challenges than just COVID. It also has all the Brexit legacy challenges, which won't be ironed out in any great hurry.
This goes back to, this feeling that central banks aren't there to aid markets, but they're there to aid the economy. And you were saying about this 1% rate hike expectations in 2022, and it's not so much what markets are expecting, but more of a risk premium being priced into the markets. But it has been a pretty bold statement, or that's what some people feel. The fact that the central bank did hike rates in the December meeting was a bold statement that maybe they were more concerned than they were letting on about inflationary pressures, and there were those factors that they couldn't ignore anymore. So looking at how markets reacted after the meeting in December, we did see a spike higher in the pound. Obviously, there was a lot of optimism to be priced into there. The way the pound was trading against the euro and against the dollar, there was a lot of space for some optimism, some surprise to be priced in after the meeting. But then it came back down straight away, and now there's a bit of uncertainty about where the pound's heading in the short term. What does this tell you? Are we hooked onto cheap money? Are we scared now that this liquidity is going to be drained? Given these market expectations, are markets now scared about actually the central bank taking this seriously? What's going to happen now with all these easy financing conditions? What are your views in terms of more specifically with the markets and how they are concerned about these rate hikes?
Well, it's actually quite difficult if one's looking at this time of the year, and this is really why they should have gone in November rather than December, because we've got very thin liquidity conditions, and actually they get thinner every year. So some of the market reaction really is a question of, has somebody basically thought that, made an assumption of a position that they can hold over year end, it suddenly shifts and they feel like either they have to square up or chase. It doesn't really matter what they're doing, but it creates very volatile conditions. And that's why central banks basically generally are trying to avoid taking interest rates in unless they're hugely well flagged, which this one obviously wasn't. I think markets are very much that they're scared by, they're scared by, has the Bank of England in this particular example taken action which they should have taken before at precisely the wrong moment, at the moment where basically we are going to see some further hindrances to the economic outlook. And that's really what they're running scared of. But it is mostly about underlying positions. I'm not sure that one can extrapolate too much from current price action, other than to say the conditions are thin, and on the other hand, also the Bank of England is creating a very random policy environment. And I think that's really what it's about. Markets are scared that they're not going to get the guidance, and they don't know what to do then. And they probably, in that particular case, start to look elsewhere and say, you know what, I don't understand what where they're coming from. And this is actually a big danger for the UK.
Right, let's finish off quickly with the European Central Bank. And as always, the most dovish of the banks, or the Western banks at least, everything left unchanged. Yes, we have seen them acknowledge inflation a little more. No rate hikes expected in 2022. And a lot of people talking that if they do a drawback in the purchasing, the pandemic aids, asset purchasing, that they will just do it somewhere else and balance it that way. What are your views with the ECB going into 22, and what do you expect them to do?
I think in terms of expectations management, they did actually a fairly good job of balancing things yesterday. They didn't top up the APP, or didn't announce that they were going to top up the APP in quite as aggressive way as people thought, to cushion the exit from the PEP program. And they've left themselves, most importantly, room for maneuver. Madame Lagarde said, I don't see a rate hike in 22. It seems very unlikely. Look at our staff projections, but I can't rule it out completely. And that's a good way of operating. I think the biggest challenge for the ECB next year is to watch what actually happens with the German economy, because at the moment, what we've got a situation is we've got France and Italy leading the way in terms of growth, particularly in 2021, and Germany lagging far behind. And Germany is an economy in transition and making, it really needs to adjust to a world where we are going to have much less equipment being made, which is basically suited to the hydrocarbon sector. And that is a huge challenge, mostly for the government, but it does play into the ECB's thing. And it's also got this other problem. If you look at the Bundesbank's forecast for inflation, they're going to be basically, it doesn't matter whether Mr. Weidmann's there or not. It doesn't matter who his replacement is going to be. They are going to be criticizing the ECB's, the fact that its QE is still open-ended. And this is a really big sore point. Now, in that respect, I would recall a comment which was made by former Bundesbank President Karl Otto Perl many, many years ago. The Bundesbank then was independent, and he basically said, well, central bank independence is they are as independent as is politically expedient. And that's where the French elections are absolutely critical for next year, because if we do get a shift to the right, then you may actually start to see a lot of people in France also being rather more critical of ECB policy. And then you get because the ECB is a much more political institution than most of the other ones, you could suddenly see a shift in that balance where the dovish minority, who definitely have a strong grip on the ECB, start to shift that way. I think they have made clear that if we start to see a tightening of what they call financing as opposed to financial conditions, they will react. And so they generally are as good as their word. Whether it actually makes a lot of difference, I don't know, because the real challenges in Europe are about fiscal reform and ensuring there is greater cohesion. And at the moment, with all the arguments that are going on, both at the Eurozone level and at an EC level, European Union level, the prospects for those reforms aren't great. So the ECB is essentially, in its message, basically is saying, we're not going to get the sort of reforms which will give enough of a growth spurt to the Eurozone economy for us to take action and for us to durably forecasting inflation at 2% or above.
Yeah, well, thank you very much, Mark, for your wonderful insight. That was Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International, giving us his views on what to expect from central banks in 2022.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.